Monaco 64, home of alternative economics and contrarian views. So today is Friday the 13th. Some of you might be superstitious, some of you might not. I'm not really superstitious, but it's just an interesting fact. There's quite a few stories about where it originates from. The most popular one is that it was the day that the King of France rounded up the Knights Templars, and that was 1307. But there's other theories. And anyway, Clive, let's get to the nitty-gritty. How are you? How
Well,
been?
good morning, Mario. The news for all your British skiers is that it started snowing in the mountains at 1,100 meters. The temperature today in some of the mountains is -5 degrees. So I don't
Yeah.
know if the ski resorts are open, but that might be of interest to the skiers.
I wonder
Um,
if the head of the UN will have to change his speech. He said the world was experiencing global boiling, and
well,
don't
maybe.
forget, Clive, it's still yeah, we're still technically in summer. So there you go.
Yeah. The other, eh, um, I suppose, more salacious news in Switzerland is the story about a former Miss Switzerland. Actually, it's Miss Northern Switzerland, who was allegedly murdered by her husband. He's confessed to it, by the way, and it seems that the salacious details is he put her through the blender to get rid
I
of her
saw
body.
that even came out in the papers here. It's just a really horrific story. Anyway, Clive, we were speaking yesterday about what to talk about today, and I noticed that gold, because most people think of the gold price when they look at it in dollars, but um, looking at like the gold price in pounds and euros and other currencies, it looked like it was still waiting to break out, and they did break out yesterday as the ECB cut rates, and even though they're so-called inflation target is only gonna probably be achieved in 2 years' time. They're cutting rates, and I think that's one of the reasons why gold is going up. But then during the day, we had a gold breakout in dollars from the high in August around 25.32. And we're going to look later on at some charts, but I will let you take over now and talk a little bit about what you've been seeing, not just about the gold price, but also the miners, which did very well yesterday. And I'm happy with that as well because I do have some miners. It depends on people's risk profile, of course, how much physical you hold and how much of the miners you hold.
Well, we'll get into the miners in just a very small second, but I think the important point is what's going to happen next Wednesday with Jerome Powell. Will he reduce rates by 1/4% or 0.5%? My money's on 1/4% at the moment, but if we get some data between now and then which changes that, I'll let you know. Um, I think the other thing just to say is what's more important? Is it the price of Nvidia or is it what Mr. Powell's doing to interest rates? I see more and more people talking about technology stocks and AI and Nvidia than are talking about the interest rates. It seems that the focus in the market is shifting from one of let's see what's happening to the economy to how much money can I make by buying tech stocks. So there's a lot of excitement in the stock market, which I would say basically it's getting very overblown.
Yeah,
Uh,
I
what do you
saw.
think?
Sorry, yeah, Clive, I saw yesterday because I don't watch CNBC or any of the news channel, business channels, but I see a lot of posts on Twitter or X, and someone said that the CEO of NVIDIA has been invited the last few days to CNBC or Bloomberg, whichever one. And I saw that yesterday. He commented that the AI is the new industrial revolution, and I think it's all a bit of a hype, in my opinion. I saw, I don't know if you saw a week or two ago that the traffic for Chat GPT is dropped massively. I think that's a bad sign for AI. I'm not saying AI isn't any good, but it could be, yeah, they could be hyping it. There's always a new thing near the top of a stock market bubble. Before we go further, Clive, just wanted to, I almost forgot, and I think this is important news. And I'm going to quickly share this with you and the viewers. Jan Neuenhuis, he's a Dutch analyst, precious metals analyst, and he came out yesterday with this story, which I thought was interesting. Saudi central bank caught secretly buying 160 tons of gold in Switzerland, and that has been happening since the second quarter of 2022, which was just after the start of the Ukraine-Russia conflict. And I'm going to put this in the description of this video, the link. You can read the whole story. He's got all the data that explains why the Saudis are buying on the quiet. And the reason they are buying on the quiet, he says at the end, is political because they don't want to upset the United States, as he says here. And I think the Chinese are doing the same thing. So I think this is a good segue into looking at the miners in the gold market now, Clive. And have you got
Yeah,
on this?
yeah. So exactly, in terms of central banks, they're in a bit of a race, all of them, to make sure they've got the right amount of gold, and he who buys first buys cheapest. So I think that's what's going on, and the Saudis have made their surreptitious move secretly. If that's the case, obviously I haven't got any way of checking that. But around the world, I think central banks are thinking about loading up on their gold holdings, and what better way to do it if you've got a lot of surplus dollars, which the Saudis obviously have. If you don't really feel confident about the future of the dollar, then you want to look for something else. The other side of the coin is if you have the ability to print a lot of money, i.e., you can print paper and buy gold, well, why not do it? Change your worthless paper for gold. And I think that's going on with some central banks as well.
Yeah, and
Uh,
apparently they're buying it from Switzerland, the bullion banks in Switzerland.
so if I could share the screen for a minute, please, Mario. I'll just hang on, wait, that is this one, isn't it? Share. That very quickly, that's just what you're looking at here is the CME Fed Watch, which tells us the probability that the rate next week will be between 5% to 5.25% instead of the current 5.25% to 5.5%. That's a 0.25% drop. And if we look at a year, you can see the rates, according to the CME Fed Watch, will be coming down to, if they're right, 2.75%, something like that. Mario, what I'd like to just look at is a few things. First of all, I'm looking at the silver price here, and you can see it's going back to 2010, right through to 2025. And you can see that silver is well below its peak in 2011, which was near enough $50. It's now $30. And of course, we've had a huge amount of inflation since 2011. So if silver decides to catch up with inflation, we've got a long way to go. And on the next chart, we're comparing it with gold since 2011. The reason I've chosen 2011, it's kind of a watershed moment. It's the moment when stocks started rising and gold started falling. And you can see the sort of general decline in gold here and silver here. But what we see is that since 2011, the silver price is down about 35%, and the gold price is up about 70%. So gold has been, since 2011, outperforming silver. Now, the next thing I wanted to look at here is gold versus the S&P since 2011. As you can see on the chart, stocks represented by the S&P 500 have massively outperformed the gold price. Stocks are up about 520% over the last 12, 13 years, where that's the S&P 500, whereas the gold price is up around roughly 100% in those 10 years. So stocks 500 something percent, gold 100 something percent. Stocks have outperformed. And the question is gold going to continue to outperform for the long run? And I can tell you that these things go in cycles. That won't happen. It will change at some point. When's it going to change? It will change when the excitement over the technology stocks fades. And that might be fading very soon. We don't know. I have no idea when it's going to happen. But when it happens, we're going to have a chart looking like this. And I'm going to go back to the year 2000, which is when the dot-com bubble popped. And the dot-com bubble was very much like what we're in today. Technology stocks, it was internet stocks of then. And back then, the internet stocks were flying, and that was the thing to do. But then in March 2000, the bubble popped. And here we have the same sort of chart from 2010 to 2011. And
From
guess what?
2000, you mean?
So 2000 to 2011. Yes. So it's actually from March 2000. What we find here at the bottom, you see the S&P 500 over those 10, 11 years, it lost close to 20%. Of course, it wasn't a total loss of 20% because they paid dividends, so it would probably be in positive territory, but not that much over those 10 years. If you allow for 3% a year, you could probably add 30% to that. It's probably allowing for dividends a positive return of 30, 40, 50%. Whereas over that period, since the bubble popped, gold went up 340%. So what I'm saying is if we have a pop in the AI stocks, in the Mag 7, if they start to come off, it won't happen immediately that the gold price will be rising sharply, although we've been seeing it rise sharply in the last few months. But as people become disillusioned with the prospect of AI stocks going any higher, and I'm not saying that AI stocks are a bad thing. I mean, they've got tremendous growth in the earnings and sales ahead of them, so it seems, but that's being priced in. So the question is, at what point do people say 5 years from now, 10 years from now, that's going to slow off, and they start to price in the future price? So when that happens, when the stocks stop rising and start to go down a bit, I think the gold price will really take off, and the evidence for that is what happened in 2000, the year 2000, in March 2000, when the bubble on the .com popped. And as I promised, we're going to look at gold miners. Now, as we saw in this chart here, in the last 10 years, 11 years, stocks have been outperforming gold, but gold has been outperforming stocks, which we look at here. Here I've got the chart.
Mining stocks.
Mining stocks. So if we look at the mining stocks, the gold mining stocks here, represented by the ETFs, which are GDX, that's the VanEck Gold Miners ETF, and GDXJ, which is the VanEck Gold Miners Mining Stocks Junior Miners ETF, you can see that since 2011, which is when the gold price was also peaking at the time, the ETFs, if we look at the GDXJ, it's down about 60 something percent, and the GDX, the gold miners ETF, is down about 35%, very roughly. Whereas the gold price since then is up about 40% since that date in 2010 or 11. But more recently, we see that gold has been moving up in the top circle, but the mining stocks are pretty much flat. So the gold miners, represented by the ETFs, are pretty much flat. They've done absolutely nothing since the middle of 2010, compared with the gold price, which has been rising, not 2021, beg your pardon,
Yeah.
compared with the gold price, which has been rising quite sharply since then, especially in the last few weeks. If we look, it really took off towards the end of 2023, and you see this sharp rise up about 40% since the end of 2023. Whereas what have the gold miners done since then? Almost nothing.
Yeah.
So the question is, at what point do we get the catch up in the gold miners? Um, it, it, in a normal world, I'll just come back to the. I'll stop sharing now. In a normal world, you expect the gold miners to do what the gold price does, but in a leveraged way. In other words, on the way up, you expect the gold miners to perform better than the gold price. Why is that? Because if you have a gold mining company who has a cost of production of $1,500 an ounce, that's what it costs to produce it. And if the gold price is 2,000, it's making $500 an ounce, the 2,000 sale value price of gold minus the 1,500 cost. But if the cost remains the same and the gold price rises to 2,500, as has happened this year, that profit is now 2,500 minus 1,500, which means that the gold mining companies' profits have doubled when the gold price went up only 25%. So logically, the gold mining stocks should be performing better than the gold price, but they're not. So why is that? Well, I think I can answer the question. Um, it, for me, I think people have become very disillusioned with the last 11 years. As we saw in the chart, the gold price is underperforming the S&P 500 and the gold mining stocks are underperforming the gold price. So what's happening? People are saying, gee, I should have bought Nvidia, I should have bought Microsoft, I should have bought Apple, I should have bought Amazon, I should have bought Meta, whatever all these hot stocks are. And every time they think there's a little dip, they say, "What can I sell to buy it?" And they jump. So they look at their portfolio. They say, "Oh, these golds, this Newmont or Barrick or what any of the gold stocks, they look like dogs. Sell it." And they raise the cash to buy one of the technology stocks. So I think what's been happening is people don't really care about the fundamentals anymore. They're just saying, I've got to be in this latest hot thing, and they're selling the gold mining stocks without really looking at it and simply diving into the hottest stocks on the planet. And it's dead easy. If you have a portfolio of stocks, the gold mining stocks are sitting in exactly the same place as the stocks you're about to buy, the Nvidias of this world. And I think that's what's going on. And the question is, how long will it keep going on? Well, I can't tell you when it will stop, but I can tell you what will cause it to stop. What will cause it to stop is when the tech stocks grind to a halt and people start to say, I want to get on something else which is exciting. And with the gold price going higher, we are seeing the gold mining stocks starting to rise. They're currently rising faster than the tech stocks in the last few weeks. So I think that's the point at which people start to flip over. And then, of course, we could see a very large catch up in the gold mining stocks.
Yeah, I agree with you. People are focusing on tech. The other thing they probably focusing on as well, Clive, is cryptocurrencies. That has taken a lot of the shine out of the gold sector, I would say. And the physical bullion, gold and silver, they have been doing quite well this year. I think it's more related to the central bank buying. And I think a lot of Wall Street investors and people who are even retail investors, when they think of getting into gold, they get into the miners, and I think that's why as well it's been like so moribund. Um, the other thing I would say, Clive, I don't know if you've seen this. There's been a lot of analysis of what happens to the stock market when the Fed starts cutting rates. And they noticed that in 2020, they started cutting rates and the stock market topped. In 2007, when they started cutting rates, the stock market topped. I think it was in September 2007. They even compared, they even said, even the day that the Fed first cut in 2007, guess what day that was, Clive?
Tell me,
September 18th.
what's the significance? Sorry, I missed that. What's the significance of September the 18th?
Well, that's when the Fed is going to meet
Oh,
this.
next week. Yes, yes, of course. I thought we were talking about some date
And
in the
it's when
past.
they're going to first cut in over 2 years. So
Yep.
you were saying that you don't know when it's going to happen, that people shift towards, even if they shift a little percentage into the miners, it's going to make a huge difference. Yeah, and we don't know when it's going to happen, but I think it's getting closer. But Anyway, Clive, uh, I wanted to show the viewers as well because as we speak here, the price of gold is at 25.70. We
No,
new
it's gone
high
up a lot, hasn't it, in the last few days?
25.71. And I was speaking to you yesterday that I thought the price of gold in dollars had already broken out, even though we're still like for the last couple weeks, we were like here, waiting for it to go up. So it has gone up. And what I meant by breakout was here. I thought we'd broken out already. And my view is that we're going to see the distance that we've seen since February to April, which was about $450 or so. Once it breaks out of this, we could see the same kind of move. But of course, it had been like consolidating here, and you never knew if it was going to come back down. Right now, it looks like gold could be on its way, and the target is just below 2,900 or thereabout. But the reason why I think gold in dollars was waiting here was because of this. Because if you look at the gold price in euros, it still hadn't broken out from the April high. And yesterday, with the rate cut, it finally broke out. And we are right now, where are you? 2,317. Same thing for the pound. And this makes sense. Sorry, just this makes sense because the dollar has been weak in the last few months, hasn't it? So, but now it looks like every currency is catching up or going down versus gold, versus the pound as well. Here's starting to break out. I think the high in April was, let's see, 1954. Right now we're at 1954. I wonder, Clive, the Bank of England and the Treasury have something called the Exchange Equalization Account. I wonder if they keep an eye on this to try to maintain the value of the pound. I think they do. But well, I had a target here for the euro, 2,700. I think we could go there. And this target, I have a time frame is towards the middle of October. So I think we could see a major move coming soon. And then the target for the pound price is 2,300. And I looked at all the other currencies. We've got the Chinese yuan. We've got the Aussie dollar. That's making close to new highs. The Canadian dollar is definitely the gold price is breaking out. And we've got the New Zealand dollar and the Swiss franc. Your Swiss franc still holding, but I think gold will eventually break above this 2,200. So what's your view on that, Clive? What do these charts tell you about gold and the fiat currencies?
We're seeing a generalized decline in the buying power of fiat currencies generally. And the reason for that is all governments around the world are borrowing money to finance their economies. So they raise taxes, spend those taxes, and then they need to spend a bit more, so they borrow the difference. So the government debt gets bigger and bigger. And as the government debt gets bigger, the government gets poorer, but somebody out there gets richer because they've got that money. And when you spread it around, some of the people who've got that money are going to put it into hard assets like gold and silver because they're going to say, hey, if the government's creating money out of thin air, effectively by borrowing it. If they're borrowing it, it's never going to be repaid. We kind of know that. So they're creating money out of thin air. That means the value of money is going down. I'll buy something tangible that I can rely on. This is not new. It's been going on ever since the beginning of time. And the only time it comes to an end is when you have a complete failure of the currency. And then they restart the system with the promise, we'll never let that happen again. But if you want look at those lovely charts of the gold price breaking out in almost every currency, if you want to guarantee yourself a profit, I would say go and buy your gold using Argentinian pesos, and you're going to be laughing all the way to the bank because probably next week, next month, your gold price in pesos, no matter what it's done in dollars, will probably be much higher because, of course, they have a very high inflation rate in Argentina.
Yeah.
But in the inflation rate around the world, it's not the headline number that you see from the Federal Reserve or from the ECB. The real inflation rate is the increase in the quantity of money and potential money, i.e., what the government owes you and promises to pay you 1 year, 2 years, 5 years, 30 years from now. That's the real inflation rate because that money has to come into existence because the government, as I see it, has no way of ever repaying their debt. They're not going to raise taxes to such an extent that they can actually finance their deficits. So, in my view, we're in a perpetual inflationary world now, which started, I think, started in earnest in 1971, when up until that date, all countries were linked to the dollar under the Bretton Woods Agreement, and the dollar itself was linked to gold at a fixed price. So there was a restraint on countries spending more than they got. But now every country is freed from those shackles. And whenever they have a crisis, whenever they need a new project or something exciting they want to spend money on, they just borrow it and print it.
Yeah. Yeah, I agree, Clive. And I'm still going through the Great Depression, a diary by of Benjamin Roth. And he was a lawyer that lived during the Great Depression, and he kept notes or a diary about what was going on economically with the markets. And it's interesting that he notes, like in the 30s, 35, 36, even the whole how people were concerned about inflation because the government kept borrowing. They kept issuing more debt and debt, and it didn't come through right away, the inflation. And then you had World War II. They were able to control prices. But when you look at what happened in the 50s and 60s with inflation and even the 70s, I think it was a consequence of all the debt that the government took on, not just for World War II, but for the Great Depression. Uh, and it was payback time. And what I'm trying to say here is that I think over the next 10 to 20 years, it's going to get even worse, the inflation. But one thing that we have nowadays, a tool that we have that we can use to protect ourselves, at least for now, Clive, is that we can buy gold. At the time, Americans they they couldn't buy gold uh, up until 1975. So for 40 years, they weren't able to protect themselves, and I think it was a great crime, financial crime, to stop people from being able to protect their savings from confiscation. Uh, are
The
they?
funny thing, Mario, even though they were not permitted to buy gold, they were permitted to buy silver. And the US government, right through until 1967, was selling, when I say the government, it was the Treasury, I suppose, or maybe it was the Mint, was selling silver at a fixed price of $1.29 an
Mm,
ounce. So the trouble was, as this started to happen, the pressure on the silver price was increasing, and there came a point where the mint said, "Okay, you can't have your silver or any silver unless you are a genuine user, industrial user of silver." So they started to restrict the usage of silver, and then to cause more mayhem in the silver market, some copper miners went on strike, and silver, which was being mined, was mostly a byproduct of copper. So there wasn't nearly as much coming out of the mines. And I think it was May 67. I might be wrong on that date. It might have been 65. I think it was May 67. The silver price jumped by 25% in the month and then continued upwards and never looked back. Of course, because that started to happen, Americans were illegal. Well, it wasn't quite illegal at that point, but they started to melt down their silver coins. They brought in rules to make it illegal to melt your silver coins because you could melt your silver coins, which were worth $1.29 an ounce in theory, because that's the official price in America, and sell them for much more as bullion. Uh, but of course, the silver price, $1.29 back then. Look where we are now. We're nearly $30. I expect we might be over $30 today.
yeah, so I guess what you're saying is that, yeah,
From
Americans couldn't buy,
1967, it was
yeah, couldn't buy.
1.29.
So Americans couldn't buy gold, so they started in the 60s, let's say buying, hoarding silver coins because they
Hmm.
protect. So they had to stop. They stopped minting, I guess, 90% silver after 1964, and
Correct.
then the COMEX silver contract was already trading in the 60s, but like you said, the government capped the price at 129. So that's interesting. Hope we never know, Clive. They if they're gonna ban people again in the US or in the UK, but I don't think so unless it gets to be a real rush. I still think I was looking yesterday, Clive, at the newspapers online, FT and all the other ones. Nothing about gold, not even a zero hedge. The fact it was making an all-time high. And talking about silver, Clive, the other day I went into town and there's a pawnbroker that usually they sell some silver coins and gold coins. I don't usually buy it from them because it's more it's better to buy it from a dealer, but sometimes they have interesting things. And they had this 1 ounce silver round called the Peregrine Falcon, 1 ounce silver. And I thought this was a nice coin. And it was minted by by Baird and Co. Their bullion merchant in Hatton Garden, London. Hatton Garden, for those of you who don't know, is the jewelry quarter in London. And I think Baird, they've been in business for many, I would say over 100 years. So I thought that was nice. And the price, Clive, is pretty similar to what you have to pay online. So I lifted it as we'd say in the markets, mine, you know.
If you have a coin or a token, that one is a token because it's not an
Yeah.
official coin of the realm, and it's written 1 ounce as yours is, and it's written 999. It means that everybody everywhere on the planet can instantly know what it's worth. So if you are buying silver, I strongly recommend that people buy silver which has got the weight and the fineness written on the front of the coin, as
Yeah.
opposed to there are many coins which are in fact silver, but you don't know whether they're 100% pure, unless you look it up, and you don't know exactly what the weight is. But that one is quite clear. It's 1 ounce and it's 999. So if you're buying in a pawn shop or from a dealer or on a street market, have a look and be prepared to pay a little bit more if you've got that 1 ounce written on it and if you've got the 999, because it means that you can be absolutely sure that everybody's going to trust it. Of course, you have to know how to check whether it's real silver and not buy a fake, but that's very rare.
5 years speaking about government borrowing and spending, and that's not going to stop. I don't think it is because under a fiat currency system, if you stop inflating or increasing the debt, you're going to cut the supply of currency and you're going to bring the system down. You sent me something about the Office of Budget Responsibility, OBR, here in the UK. Uh, they're talking about the fact that the debt to GDP could go to like 270% in the next 30, 40 years. And they're using climate change as an as an excuse, which I think is a little bit, um, I'm not sure I agree with it. I do agree, though, that the finances in the UK are in trouble. And unfortunately, not just the Labour government, but the Conservatives, they're not doing anything to try to incentivize the private sector by cutting the size of government and spending. I think Liz Truss might have tried to do that, but she didn't last that long. So, what's your view on that? And I can share that uh, document you sent me if you want.
If you can share the screenshot of
Yeah.
that particular page, I think it's 21 or 22.
Yeah, here you go. Office of Bud for Budget Responsibility 2024 Fiscal Risk and Sustainability Report. So it was issued yesterday, actually. So this stuff here, I'm not too sure about climate change, health and demographic. I agree with, but
But if you go when you get to the
page 20,
towards the end, you'll see the prediction that there's going to be a huge rise in government borrowing as a
Oh yeah.
percentage of GDP. You're
Yeah,
on the right page now. Level of government debt, you can see it's rising depending on which line you take. They've got the sort of baseline, a higher line, and a lower line. But no matter which one you take, it moves from 100% of GDP now up to over 200% or over 250% or over 300% based on their three possible scenarios. So the question is, at what point in the UK, and what point in the USA, and at what point in Japan, and so on, is the level of debt to GDP too high? Uh, Under the Maastricht Treaty, which I think was about in the 1960s, have I got the date right? Anyway, under the Maastricht Treaty, they set
1990. 1990.
okay, 1990, they
Six,
set the
right?
level of government debt. It should not exceed 60%
That's
to
right.
be part of the EU. And the reason they set it at 60%, that was the maximum level of debt to GDP, which was seen as a level where the economy could continue to be growing at the right rate. Well, of course, we're in many, many countries around the world, we're well above that now, well above 60. And in some countries, we're well above 100%, UK being one of them. So USA too. So we're already in territory which is regarded as unsustainable in the long term, and there's no turning back from these levels.
Yeah, this one is quite optimistic, the higher productivity one. The other thing I would say about the government debt, they don't include about 600 billion that the Bank of England holds because they say, well, for some reason they don't. So I would say this 100% that we're near now is or here is more like 130, a bit like the US if you include all the public debt. And you might say, well, it doesn't matter because the Bank of England and the government are the same. But right now, Clive, we're paying like over 20 billion pounds a year uh, through taxes to the Bank of England because they're losing money on their government bond holdings. So I think this is even worse. And I think this is why they're going to continue to try to inflate the system because that's what they did from World War II to 1980. And what that means to inflate the system, it means that they're going to debase the currency so that the government will be able to pay its debt with currency that's become worth less and less. Maybe you can talk about the example of the the consols or the perpetual bonds in the 19th century. I think your grandmother had an
Yep.
experience with that.
So,
Back then, it was a lot of money, but now the government can pay it off because it's inflated it away.
um, it was my grandfather on my mother's side who had owned some war bonds, I think they were called, and they had a decent rate of interest. I don't know what the rate of interest was. Perhaps it was 5% or something like that. And at some point, uh, these bonds, which had a maturity date, were turned into perpetual instruments called consols. And I think the rate of interest was much, much lower. Maybe it was 2.5% or something like that. But so my mother, when she finally got her hands on these bonds after my grandfather's death, was complaining that the rate of interest he'd signed up for in the war wasn't what she was getting anymore because they'd reduced the rate of interest and they'd got rid of the maturity date. They were now perpetuals. Anyway, in the UK, interest rates went to zero or thereabouts. And guess what? 2.5% now look very attractive. But guess what the UK government did? They redeemed them at par at 100.
It,
So,
it, it didn't
uh,
cost that much because they had inflated the currency so much already. And that's the lesson I think for people who buy bonds, especially long term.
I have we're talking about currency. I had a bit of a funny story. I was watching a Netflix series called Better Call Saul. I don't know if you've seen that one.
Yeah.
Saul is a sort of two-bit lawyer. He's got no money. He has a really pokey little office. He's always short of cash. Uh, but anyway, he manages to land a potential client, and he goes to see the client. And the client says, "I'm wanting to make my own country in this particular area. There's nothing here, and I want to separate myself from the United States and become a country of my own. And I want a lawyer to help me do the legal work. And so Saul says, "Well, yes. What about the fee?" And he says, "Well, I think the fee. How about $1 million?" Of course, Saul's face uh, brightens up, and the man says, "And I'll pay you in advance." And he goes to his safe, opens his safe, and comes out with a suitcase loaded with cash. And Saul takes one of the banknotes and looks at it, and it's got the man's face on the banknote. He's just printed his own currency for his own country. Of
Yeah,
course, Saul does not take the contract because he doesn't want to be paid in paper money.
that's a good one. Uh, talking about Netflix, um, I watched the other day a new series called Wyatt Earp and the Cowboy War. And I like the story of Wyatt Earp, but this one is really interesting, Clive, and you should watch it because it talks about how important silver was to the whole story. And it even mentions, guess who? J.P. Morgan and Lord Rothschild back in 1880 because at the time J.P. Morgan was trying to consolidate all the railroads in the U.S. and the problems in the Arizona territory with the Earp brothers and the cowboys was making Lord Rothschild not too keen on putting his capital with J.P. Morgan. So I thought that was really interesting. And if any of you have Netflix, I recommend it.
What was the name of the movie again? Of
What
the serial?
it's like a docu-series, Wyatt Earp and the Cowboy War.
Cowboy War. Okay.
Yeah.
That period from the 1890s, 1880s through to about 1905 was an extremely interesting period because the dot-com bubble of the day was in fact the railway stocks. These
Yeah.
railway stocks were effectively like a spider's web throughout the United States, just like the World Wide Web. They'd all come into hubs. The goods would change trains, go to and then go on another line. But each railway was owned by a different company, and there was a lot of consolidation going on. And at one point, there was a bid for one of the railway companies. I think it might have been Burlington Northern. I'm not sure about that,
Yeah.
but there were two moguls, railway moguls, who each wanted to own that particular railway line, and the American stocks were had been in a big bull market because of railways in general. But this particular stock started rising very fast, and it went to extremely unreasonable levels because as we now know, these two moguls each owned more than 50% of the stock.
Mm.
So there was no stock to be delivered in the market. And this particular stock went up to the moon. It went from something like a $30 to $1,000. But what it did to the stock market, it crashed the stock market because so many people were shorting the stock which was
Mm.
rising, hoping to borrow it. Then they couldn't borrow it. They had to buy it back. That to raise the cash for their margin calls, they were selling everything else in the market. So you had a crashing stock market with one stock going to the moon.
Yeah, I think that's the Jay Gould and James Fisk Railway. They try to corner uh, the stock. That was in 1869, which was a bit earlier.
This would be about 1900 roughly
Oh, this
when
one's
this happened.
19. Oh, okay, so there must be another one. But the other thing, Clive, that in this series, the Wyatt Earp one, is that they have a scene where J.P. Morgan's in London meeting Lord Rothschild in his huge estate or outside London. And he says there's a lot of, and they just found a lot of silver in Nevada and Arizona. And the problem was that the Cowboys were ambushing the Wells Fargo Pony Express, which was transporting a lot of silver back to New York. But it's interesting that JP Morgan said that they wanted to put the dollar on a silver standard. He said that to Lord Rothschild, which I thought was really interesting because when we look at silver, we talk about the great crime of 1873, that they didn't want silver anymore. But in this story, apparently JP Morgan was saying, yeah, we're going to put the dollar on the silver standard, which I thought was interesting. I'm not sure how. credible that is. So, Clive, any final words as we wind up here and move on to the weekend?
First of all, thank you very much for having me on your show, Mario. I appreciate that. All your listeners should do the thumbs up. And yeah, I wish everybody a very nice weekend.
Yeah, me too. I wish Clive and all of you a nice weekend. And if you want to connect with Clive, he's on LinkedIn, Clive Thompson. And by connecting, I mean if you have questions and you want to talk about things pertaining to markets and economics, you can
So
do.
yeah, if you write to me and say, "Hi Clive, how are you?" I won't reply. Or if it's "Hi, Mr. Clive," I definitely won't reply.
All right, great. Thank you, Clive, and take care.
Bye bye now.
Bye.